In this video, I will be covering accounting for cash dividends. As you will see, the challenging part about cash dividends is not so much the accounting, which basically is quite simple. Give me a second. You're going to have a debit to a cash dividends account for the amount of the dividend. That's similar to withdrawals for proprietorships in your accounting 1A class, if you remember that far back. And there's going to be a credit to cash dividends payable account for the amount you owe now to your shareholders, but you haven't paid it yet, so it's a payable account. You call that cash dividends payable, and eventually when you pay it off, you're going to get rid of that dividends payable account with a debit, and finally you're going to pay the cash. So as you can see, very simple in terms of the actual accounting. The most challenging part for dividends, cash dividends, is actually coming up with the calculations. So we'll be going through this part right now. Now, in this example or this problem, you've got 100,000 shares of common with $50 par value. Then you have 20,000 shares of preferred, cumulative preferred common shares at $100 par value with a 1% dividend rate. So, and then you also have some declaration of dividends each of these 3 years. You're going to have year 1, year 2, and year 3. $10,000 of dividends declared in year 1, $45,000 in year 2, and $80,000 in year 3. The question is how much of these declarations goes to each class of shareholder. How much of it goes into common shareholders, and how much is given to preferred. So you have to actually go through the process of allocating the dividend each year, and you start with a dividend rate of 1%, and you say you're going to actually apply the 1% against the par value of the preferred shareholders. And by the way, you're going to pay the preferred shareholders first. That's the whole reason of it being preferred. You have a preference over dividends. They go first. So each accounting period, when you declare dividend, they need to be given 1% of $100, which means $1. And so there are 20,000 shares of preferred. That means that $1 times 20,000 shares, dividends should be paid at a rate of $20,000 per year to the preferred. So that's what you see here in this worksheet under year 1. This is what it means. So the current dividend owed to preferred shareholders in that first year is $20,000. The dividends in arrears means the dividends that have not been paid previously. If you read the chapter, you will see that there's something called dividends in arrears. That only applies if they're actually cumulative, like in this case. So in this case, since this is the first year, there's nothing there, so that's always 0 for the first year. Now, since they declared $10,000 declared dividend, they get the full $10,000. So that's how much they get. And that leaves nothing to common shareholders. So this is for preferred, and this is for shareholders. For common shareholders. Now, they were supposed to get $20,000. They only got paid $10,000. That leaves $10,000 in arrears for the second year. So let's go to the second year now. Second year, you're gonna have the very same dividend rate for that year for preferred, which means again another $20,000. So the current dividend is $20,000. The dividend in arrears is $10,000. So they owe the preferred shareholders in that second year $30,000. In the second year, they declared $45,000, so they can pay the full $30,000. $45,000 minus $30,000 going to preferred leaves $15,000 to common. And now, since they paid off all of the preferred, there's nothing owed in arrears for the third year. Third year, again, $20,000 current dividend for preferred, 0 in arrears. They owe $20,000. They declared $80,000. They paid the full amount, and the remainder, $80,000 minus $20,000, leaves you $60,000 for common. And so again, if you go into the JEs for each of these years, you see that's what they actually have done in each year, those amounts. Now the last portion here is simply taking the overall dividends received per class of shares. So in this case, 10,000 divided by 20,000 shares, that gives you the 50 cents. 10,000 divided by 20,000. I hope that's right. And then in this case, the preferred shareholders got $30,000. Again, divided by 20,000 shares should give you 150. The common shareholders got 15,000. They have 100,000 shares. That's how you come up with $15 earning dividends per share. And then the same thing for year 3. You can follow that on your own. Hopefully that was helpful. Take care.